This webinar will help you gain a practical understanding of insurance and its applicability to your contracting operations. We will touch on different types of insurance, workers' compensation, contractors, equipment floater, professional liability or errors and omissions, OCIPs and CCIPs or wrap-ups, and how to mitigate the impact of insurance costs to improve bidding. Let me begin the presentation. Hold on.
And are you sharing your screen?
I don't think so.
Okay, just wanted to make sure.
I'm not sharing yet. Actually, we're having a little technical problem here. The share button doesn't seem, wait a minute, there it is. Hold on. There we are. Can everyone see that?
There you go. Good here.
Okay, so it's just, you're seeing just the whole screen, right?
Yes.
Okay. Well, with that, Kirk, take it away.
Happy to. Thank you, Ken. Good afternoon, everybody. My name is Kirk Chamberlain. As Ken mentioned, I lead Hub's national construction practice based in Chicago, but actually currently sitting on the West Coast. So enjoying a little sun here in Northern California. Purpose of today's presentation is really just to provide a kind of a high level overview of the insurance marketplace, your interaction with the insurance marketplace, and how that relates back to what you guys do every day, which is to build things. So we go to that next slide, Ken. So this is the agenda. We're going to kind of keep it high level today. If you have questions or if you need us to go a little deeper in detail on any of these topics, please raise your hand. I think there's an ask questions feature where you just raise your hand. Ken's going to try to track those questions, and then we're going to periodically sort of take a pause and address the questions. So please don't be shy. If you got questions, please ask them. So again, the purpose of today is not to go too deep in the technical side of insurance. That's really why you hire an insurance broker and agent, is to help you work through the details. But I do think it's important as business owners and as operators in the construction space that you've got some idea of what the value proposition of insurance is, why you buy it, why your owners, your contractors, your other stakeholders require you to buy it, and what the value is, what it's really designed to do. It's not just a sunk cost. It's not just operating a frictional cost in your business. There's some real value on the insurance side in addition to just being compliant. Can we go to the next slide, please? So quick commercial about Hub, which is the company that we all work for. We are a large broker, North American broker, US and Canada. We work among other industries in the construction space. Construction is my area of expertise and our team's expertise. We have a little over 1,000 people on our national construction practice in the US and Canada. We have a large book of contractors. That's our primary business, is working with you, the contracting community. We've got about 10,500 GCs and somewhere north of 25,000 subs and trades. So this is something that we do every day. We work also oftentimes with owners. So we're oftentimes on both sides of the conversation here with both the owners who you work for and with you and your peers. Next slide, please. So if we jump in and go to the next slide, this is, we're just going to kind of high step through this a little bit. This is not going to be unfamiliar to any of you, but I wanted to just recap the different types of contractors that we work with and the different types of contractors that you'll be working alongside and partnering with, because all of these different stakeholders or operators in the construction space all buy insurance, all have insurance requirements, but they're all going to be varied a little bit based on the type of work they do, on the role that they play, and where in the value, where in the contractual stack do they sit. Next slide, please. So again, this is not new, but just general contractors and CMARs or CM at risk. We really view these two types of operators in the same category. So these would be obviously contractors that are holding contracts on behalf of an owner. Next slide. As opposed to on a construction manager, again, agency CMs, they do more of a consulting role. They typically don't hold subcontracts on behalf of the owner. They're really there in a pure consulting or professional services role. So their risk profile and their insurance requirements are going to be different than a GC or a CMAR. Next slide. Same thing with project managers. Again, these are more like owner's reps, pure consulting role. Again, don't hold contracts typically, so their risk profile is going to differ substantially from a GC or a CMAR. Next slide. And then this is the bulk of, I imagine the bulk of the audience today, folks watching, is going to be self-performing trades or subcontractors. These are the people that are doing the work. These are the folks swinging hammers, pouring concrete, hanging steel. This is also where the bulk of the risk lives. So this is where the activity happens. This is also oftentimes where the claims arise, is folks that have the crews in the ground, in the field, doing the work. As a result, this is where the bulk of the insurance spend tends to happen on behalf of an owner. So not the GC. The GC will buy insurance and have a spend there. But typically the bulk of the money that's being spent on insurance is going to happen right here with the self-performing trades and the subcontractors. Next slide, please. And then you've got all of the other people that are part of this package, part of this risk profile, which is all the design consultants, the lead designer, the architect, the engineering consultants, the geotechnical engineers, life safety, landscaping, you name it, right? There's all sorts of different types of professional services providers. Again, they also buy insurance, but their risk profile is a little bit different because this is all professional services typically. So this is more of an E&O type risk, and we'll talk a little more about that in a minute. Next slide, please.
If I can interject here,
Sure.
Rena and Fawn, let me know if there's any questions in the Q&A or chat because I'm on full screen. I can't see that. So if you would let me know, and then we'll address those questions as we go along. Thank you.
Okay.
Awesome. And then lastly is your suppliers. So concrete guys, steel guys, folks delivering framing materials. Again, part of the ecosystem. They also buy insurance. Their role is a little bit different. Typically, they're just coming on and off the site delivering materials. Their risk profile is different, so their insurance spend is going to look a little bit different, a lot different than yours as a contractor. Next slide, please. So this is kind of what the ecosystem looks like. So every single participant in this ecosystem, again, is working either directly or indirectly for the owner. So what typically drives their requirements are contract provisions, and we'll talk about that in a second. But every single partner on this page is going to have an insurance requirement that they're going to have to meet in order to protect all the other stakeholders, including the owner here. The next slide, please. So the other thing that tends to drive how we approach from an insurance perspective is how is the project being delivered? And the two main ways to do this are either design, bid, build. So again, you're probably all familiar with this, but this is where an owner would hire an architecture firm to work up a package, a design package, and then they separately hire a general contractor or a CM to build that project. By doing that, what they've done is they've separated the design risk from the construction risk. That's what we call design, bid, build. The alternative is design, build, which again, most of you I'm sure are familiar with. That's where we combine those two things together, where typically the owner will hire a firm that will do both the design and the construction, either within the same package, or they'll hire a contractor to do the construction. That contractor, that general contractor, will hire a design firm underneath them. So those are the two mains, and both of these things will drive the insurance conversation in one direction or the other. Next slide, please. So next slide. These are the insurance requirements. These are really the questions that we're trying to address today at a high level is why do I buy insurance? Why am I spending tens or hundreds of thousands of dollars a year on insurance? So here's the main five reasons, sorry. First and foremost, it's really there to meet your contractual requirements in both upstream and downstream, typically more upstream for you guys though. It's also going to be a requirement for certain lines of coverage in order to meet federal, state, and local regulatory requirements. So this would be, maintaining your contractor's license, things like work comp, which is mandatory in almost every state. So there are local regulatory and federal regulatory laws that you have to meet, and insurance is part of that compliance. Typically also, most owners are going to be borrowing money to build whatever it is they're building, whether it's apartment building or a bridge or a professional sports stadium. Those lenders are also going to have an opinion and requirements of their own So all of these requirements kind of wind up landing in your lap, and we see that manifested through the contracts. And the last two are really, in my view, the most important, which is number one is to protect your own people and your own assets. Number two is to protect your bottom line. So the first three are really things that you have to do in order to meet your contractual requirements. But the last two are really personal to us too, right? It's how do we protect your people and assets, and how do we protect the bottom line to make sure that when you bid this job or you bid this work, you're going to be able to make some money off of this. Next slide, please. So here are the key coverages we typically see in almost all construction contracts. Everything on this slide except the first one, workers' comp, is an optional coverage. Optional in the sense that it's something that the owner or the general contractor can elect to require you to provide. It's not something that the federal, state, and local governments are going to require you to buy. The only thing that the government requires you to buy is work comp, except in the state of Texas, which you can opt out. Everything else is optional. But we typically see all of these other coverages in pretty much every contract and every project that we work on. Next slide, please. So let's drill down a little bit. One other thing that, again, kind of like design build versus design bid build, once we figure out what insurance contractually you're being required to provide through the contract, then we also need to understand how is the owner deciding that they want to buy that insurance. So again, we establish the coverage first, coverage requirements, limits, things like that. And then how are we going to purchase it? What's the most efficient way? What's the way that the contract stipulates? The most traditional way is that first one, which is bring your own insurance, which is every contractor, general contractor, subcontractor, subcontractor would have a contractual requirement with certain insurance provisions in that contract that they're required to meet. That's what we kind of call BYO, or the traditional everyone brings their own insurance model. That's how we've done it for years and years and years. It's not necessarily the most efficient way to buy insurance, but it's how we've all kind of grown accustomed to it. Everything else below that is some form of what we would generically call a wrap-up, which just simply means that instead of requiring or allowing all of the individual contractors and subcontractors to bring their own insurance and meet their own insurance requirements individually, we buy insurance, and we, being the owner typically or the contractor, will buy insurance on behalf of everyone participating in that project. That's what we call a wrap-up. You'll see that toward the bottom there's different flavors of wrap-ups. The wrap-up, the formal term we use is controlled insurance program, but better known as a wrap-up. There's OCIPs and CCIPs, which is an owner-controlled wrap-up or a contractor-controlled wrap-up. The only difference there is the O and the C. It's who's in control. Coverage-wise, it's identical. So we can go to that next slide, please. So here's some of the construction risks. So we can go to the next slide. When we write insurance policies, what we're doing is we're reacting or responding to the risk in the project. And virtually every project that you'll see is going to have all of these sort of core risks in it. First, we start with property. The most common that you're probably familiar with is builder's risk. What builder's risk is designed to do very simply is it's designed to cover all of the property-related risks. So these would be things like fire, theft, a hurricane, a tornado, hail damage, anything that could happen to the physical property associated with the project. And that's not just the project itself. That's all of the materials that might be stored on site. They could be materials stored off site. They could be materials in transit to and from the site. All of that is property. Anything that's going to be permanently incorporated or put into the project by way of materials is considered property and covered under the builder's risk. In addition, there's some others, and we'll drill down on this in a second, but there's some additional special coverages that are associated with builder's risk around things like delay, soft costs, things like that, and I'll explain that in just a second. Second important property coverage is what we call an installation floater. That's very similar to builder's risk. The only difference between builder's risk and an installation floater is how we use it. So typically, and this is a general statement, is anytime we have construction that's coming up out of the ground vertically, like a building, let's say, where there's physical property that's going to be extended above the ground, we would normally use a builder's risk form or builder's risk policy to provide us the property coverage that we need for that. If instead it's the property or the content we're building is either below or at grade, so let's say footings and foundations, or let's say we're building a tunnel, or we're laying concrete, or maybe we're putting in sewer piping, right? Something that's at or below grade. Instead of a builder's risk policy, we use a different form of property insurance called an installation floater. That's really the only difference between the two. They're designed to do the same thing, which is to ensure all of the property that's incorporated into the project. The only difference is basically, is it coming up out of the ground? If it is, then we use builder's risk. If it's something that's below or at grade, below ground or at grade, then we're going to use the installation floater. And that's generally that generally applies to almost all projects. Third important type of property coverage is the contractor's equipment, or what we call inland marine coverage. Can't tell you why they call it inland marine. That's an old term that's been around forever. Contractor's equipment, though, is what it covers. So that's all of your stuff, your backhoes, your skid steers, anything and everything that you own by way of mobile equipment, tools, anything that does not become permanently part of the building that you use to build that building, generally falls into the contractor's equipment category. And that includes things like mobile equipment. Does not include autos or anything that's licensed for the road. That's covered separately under an auto policy. Next slide, please. Second very important coverage is the general liability. So I won't read the slide, but just as a general kind of statement, what general liability does is two important things. Number one is provides all of the stakeholders, you, the GC, the owners, anybody who's involved, with protection against lawsuits in the event that somebody gets hurt during the project, during the course of construction. Not employees of the contractors, that's covered under work comp, but this would be somebody of the public, a couple kids break into a job site and screwing around, spray painting the side of the building and they get hurt. That's a general liability claim. Let's say a piece of steel falls off the top of a building onto a street and lands on a car and hurts somebody. That's a general liability claim. So that's a really important coverage that's required in virtually all projects. Under the GL form, the GL policy form, there's two main coverage parts. The first covers what we call premises liability, which is that stuff that I just described. It's things that would happen at or near the job site during the construction phase while you're building it. That's premises liability. The second half of the general liability policy is what we call completed operations or products or completed operations liability. That covers things like construction defect. So first part of the coverage, the premises liability covers any liability that happens during the construction phase. The second part of the GL policy, the completed operations, covers any kind of a subsequent liability or claim that happens once the project's completed. Roof leaks, windows leak, foundation cracks and sags, building falls down 2 or 3 years after you completed it. That's covered under the GL under the completed operations portion of that policy. That's what we call a construction defect. Very, very important coverage that you'll see required in virtually all projects. Beyond that, the next 2 or 3 lines are very specific types of coverage and endorsements that we like to see on policies. Again, we won't go into detail on these unless you have some specific questions, but these are all very important endorsements or additions to the general liability form that we want to make sure that are added to protect you as the contractor and to protect the owner. Make sure it's done correctly. Next question, or next slide, sorry.
Okay.
Work comp, all of you are probably familiar with this. This is the third very important coverage. This is the only statutorily required coverage that you have to buy based on state regulations. This does 2 very simple things. It protects your people, your crews, your teams in the field against injuries that happen during work, as a result of working on the project site. It also protects them for lost wages. So it's injuries and lost time. That's really what work comp does. And that's all it does. Beyond that, there's some other additional important endorsements. Again, we won't go into these unless you have specific questions, but every state has a slightly different variation of work comp and slightly different rules. So this comp policy has to be modified and usually has to be endorsed depending on where the project's going to be built and what the unique, statutory requirements are of that state. But the form itself is very simple and it's very, very standard. Next slide, please. So we call it excess casualty, but you might be more familiar with the term umbrella. Umbrella liability is simply just an extension of limits that we're already providing under the general liability, the auto liability, and the work comp, or the employer's liability portion of the work comp. So it's not a separate type of coverage covering a separate type of risk. It's just simply vertically extending the limits up. So again, we'll typically see umbrella limits called out in the contract, They'll tell you exactly how much the minimum you have to buy. Typically 5 or 10 million is not uncommon. But all it does is mirrors the primary liability, primary auto, primary general liability, primary auto liability, and the employer's liability into the work comp. But it simply extends those limits vertically up to a higher level. Next slide, please. And then last one, probably the easiest one to understand is the auto liability. This is, by the way, the most difficult coverage right now. All of the other lines of coverage I mentioned, the property, the general liability, the work comp, and the excess or umbrella liability, the market conditions for those right now have become fairly stable, which means prices aren't going up like crazy like they were a couple of years ago. They've stabilized somewhat. There are some exceptions to that. If you're doing what we consider to be high hazard work, so steel erection, or if you're doing demolition or environmental remediation, or if you're framing tract homes, there are certain types of risk that the liability markets remain difficult, which in difficult usually means expensive. Auto liability has remained a very difficult market for a very long time, and it remains difficult today. It's probably the most difficult line of coverage for insurance companies to try to figure out a way to make money on, which is why you see the rates going up consistently every year. So again, this covers all of your owned vehicles and non-owned vehicles. So everything that you own and is registered in your name would be covered under this policy. But also, we provide liability coverage for any vehicles you might rent or hire or borrow or otherwise use in your business that maybe you don't own. It also provides typically physical damage, just like your personal lines auto does. If you run into a tree, if you have a cracked windshield, those are all coverages that are extended and provided under this auto insurance policy. As I mentioned, though, the one difference is the only thing that's covered under auto liability are vehicles that are licensed for use over the road. So things like mobile equipment, skid loaders, backhoes, things that aren't designed to be driven on the road. The liability for that is picked up under the general liability. So it can get a little confusing, but that's not an auto liability situation. That's a general liability situation. So just the rule of thumb is if it's licensed for the road, the liability lives here in the auto policy. If it's mobile equipment or something that you can drive, but it's not licensed for the road, that liability typically is going to live under your general liability. And one other important part here is oftentimes we include some elements of pollution liability under the auto. The so-called MCS 90, which is the endorsement a lot of states require that if you're going to be hauling any kind of hazardous materials and you crash, you tip that truck over and it spills hazardous materials all over the highway, that liability is also typically picked up under the auto here, under what we call an MCS 90 endorsement. Standard practice, we include that on almost all liability policies nowadays. Next slide.
Okay.
Oh, I'm sorry, one other, Ken. Oh, sorry, Ken, go ahead.
No, I was just going to say, seeing some raised hands here.
Yes, please.
I'm not sure if the chat and Q&A is enabled. So when we get to the end here, I'll troubleshoot that if that's a problem. So,
do we have any questions now? I might take a breath and just see if we have any questions.
Someone said the chat is disabled, but I'm seeing messages in the question and answer.
Oh, okay. Do you want to? Should we bring a couple up?
The only one that I see in here says, could someone provide a brief service provided by M&W Insurance for contractors, subs, improved services? But that's it.
Okay.
And it just says chat is disabled.
Okay, I'll re-enable it at the end here. And let me go to the next slide.
Next slide, that's great. And then the last really important coverage that most of you either have a contractual requirement to provide or you may want to buy, again, just to protect your own interest, is professional liability. So in the context of a contractor, when we talk about professional liability, the most typical version of professional liability is we see with design build contractors. So whether you're a design build sub, maybe doing MEP work, mechanical, electrical, plumbing work, or your design build general contractor. And again, if you remember before, we talked about there's two ways that you handle the design in a project. One is design bid build, where the owner hires their own architect, hands those plans and specs over to you as the contractor and says, go build this. In that case, the design liability primarily sits with the architect or the engineer, not with you. When you do design build, Now you assume that design liability, for which you're going to obviously charge a little higher fee. Typically design build fees are a little higher than traditional GC fees. But in exchange for that higher fee, you're going to assume that risk yourself, and you're going to have to insure that on your own side. So what professional liability does basically is it insures your mistakes, your errors and omissions, or E&O. That's what we call it, E&O insurance. So this isn't general liability. So again, general liability might be, a piece of steel falls off the top of a building, lands on a car. So there's a property damage event or a bodily injury event. Somebody gets hurt. That's general liability. In this case, we don't necessarily have a general liability event. We don't have anybody getting hurt or property damage happening, but we could have just simply something not working. So good example, we just had this situation, or in the middle of this situation right now with a client. They were doing a design build on a student housing deal. And it was a fairly large, fairly modern building with a curtain wall. So not a traditional kind of apartment building looking thing, but more like an office building with a curtain wall. It was done on a design build basis, which meant that our general contractor was assuming all the liability for the design work as well. So they hired a subcontract design firm, right? An architect that worked for them under the design build contract. Part of their responsibility was to spec the correct curtain wall for this building, which they did. They picked the curtain wall was installed, and about 7 or 8 months after the building was delivered, the owner was reporting that the building wasn't staying cool, right? The mechanical systems that were designed for that building, the heating and air systems, weren't big enough based on the amount of heat and sunlight that the curtain wall was allowing into the building to keep the building within the parameters that were spec'd under the design contract. So in that scenario, there was no property damage, right? Nothing got broken or blown up or burned up. Nobody got hurt. It's just the building failed to perform the way it was designed to perform. So the owner filed a claim against the general contractor for economic damages, saying, look, we have to spend 50% more for our utility bill, and we still can't keep the building cool. So what the general contractor had to do is go back and remove the curtain wall and reinstall a different type of curtain wall that was more thermally efficient. Again, no property damage, no bodily injuries, so the general liability policy would not respond there. It wasn't going to indemnify them. The only recourse they would have had would have been under this professional liability policy, because the design piece of that, the professional liability associated with the design, was what caused the problem. Not bodily injury, not property damage. It wasn't installed incorrectly. It was just designed wrong, right? That's a very common one. Next slide, please. And last one, and this has become much more common in the last 4 or 5 years, is cyber liability. Now, a lot of contractors we work with, when we talk about cyber liability and explain what it does and explain what risks we're insuring against, they just don't see it. They're like, look, I'm not a tech firm. I don't understand why this is a problem for me. So here's a real world situation we're dealing with right now. We have, we represent both the owner and several subcontractors on a fairly large multifamily project, multiple phase multifamily project. And about midway through this project, our owner got an email from what they thought was one of their subcontractors saying, hey, look, we changed our banking coordinates. Here's the new account. So for future reference, when you send payment, send it to these new banking coordinates. Owner had no reason to worry or validate that. They assumed that was correct information. So the next 3 progress payments they sent directly to this new bank account, which probably wound up landing into the bank account of some 14-year-old Ukrainian kid. So that is a cyber claim. That's one that we see all the time. We call that phishing or spoofing. That is unfortunately becoming very frequent. I don't know if any of you had that experience or if you've heard stories about that experience, but that stuff happens a lot now. That's a cyber claim, potentially. Not covered by the GL. It's not covered by your E&O, your professional liability. It's not covered by your property liability or your property insurance. The only coverage you're going to find to be able to potentially recover the monies that you lost or that your owner lost and now is alleging that they sent to you is under the cyber liability policy. The other one that we see very frequently with cyber liability is under BIM, So for those of you that are, either in or probably work with BIM, which most contractors now work in a BIM environment, building information modeling environment, there's a lot of data that gets transferred back and forth and exchanged. And that's where we see a lot of problems with hackers and, again, spoof phishing exercises is, sending requesting updated design package or having questions about some design feature. We see hackers getting in the middle of those conversations between the subcontractor and the general contractor, or between the general contractor and the architect. And that is a frequent area of infiltration by hackers in the cyber environment. That's also something that we can cover and insured under the cyber liability policy. So this is something that, again, used to be really a problem of retailers and the government and healthcare and everybody else. Now it's becoming a real problem for contractors. In fact, if you remember years ago, this is probably 9-10 years ago now, there was a big cyber attack or a big cyber event with Target. This probably goes back 9 or 10 years, where Target was hacked, and there were millions of customer data files that were accessed, personal information, social security numbers, phone numbers, names, etc. That hack occurred through a contractor. And in that scenario, what happened was there was a mechanical contractor that was hired by Target to basically help balance out a brand new building was completed. This contractor was hired, and they were trying to balance the system. So it was an automated building system. They were given access to that building system. That building system happened to be tied in some fashion or another to Target's mainframe. So when the contractor got in to start doing the balancing of the heating and air systems, a hacker basically rode on their coattails and got right in the back door of Target's mainframe. And that's what caused that hack. So this stuff happens. Again, it doesn't get talked about a lot. A lot of contractors don't like to admit when they get burned like this, but this stuff's happening all the time now. So next slide, please. And then last are these, this will be more familiar to most of you, is the payment performance issues. Again, this is present in every project. In some cases, the owner or the general contractor may require you as a subcontractor to post a bond. And what you're doing by posting a bond is basically providing a third-party guarantee that you're going to be around, or somebody's going to be around to finish this project in the event something happens to you. Either you breach the contract, you go out of business, whatever happens. This is a very important part of the contract risk management structure. We typically see this almost all the time with public work, and we're seeing it increasingly with private work. There are two ways to address this issue. The most familiar way for most of you is probably the bonding or the contract surety payment performance bonds. They've been around forever. Many of you or most of you probably either are bonded or have had to have that bonding conversation upstream with your GC or your owner. And that's been around for a long time. A more modern version of this, or a more recent development, and recent meaning 40 years ago, so it's not new, but it's newer than bonding, is what we call subcontract default insurance, or SDI. SDI was really introduced again about 35 years ago, plus or minus, as a sort of better, faster, cheaper version of a surety bond. That's a product that the general contractor can buy, and instead of requiring a bond from you as the subcontractor, they can simply enroll you in their SDI program and waive the bond requirement. So many of you may be familiar with this. Many of you may have already participated in a program with SDI where the GC was able to waive the bond for you. It's a really good solution. There are times when this works better. There are other times when this isn't appropriate, and you really have to do a contract or a payment performance bond or a surety bond. But there are two ways to address this risk, and these are the two. Next slide, please. And then here's all of the other stuff that we focus on and have to pay attention to. Most of these tend to be more optional coverages, really dependent on the circumstances of the project or the type of work that you're doing. The first 3 or 4 there in black are more traditional insurable risks. The last one, drones, is relatively newer, but it's become a really big deal now. A lot of contractors now are using drones for a wide variety of reasons, either for surveying damage or doing quantity surveys, or checking on work, the status or progress of work, etc. When you fly a drone, you have a liability risk that you are facing, and it doesn't sound like it's we haven't seen a ton of claims here, although we have seen a lot of lawsuits arise as a result of drones. So it's something that has to be covered, typically picked up under the general liability, but it's not automatically added. So if you're using drones in any way, shape, or form on your jobs, you need to check with your broker to make sure that you've got appropriate coverage for that under the general liability policy, or you have a separate drone policy, one of those two. The other three are fairly common. Pollution, again, self-explanatory. All contractors that are on job sites have the potential to create a pollution event or create a risk, create a claim. You know, if you've got a mobile equipment on site and you've got a diesel tank there to top up your equipment, and that diesel tank leaks or gets knocked over, that's a pollution event, and that's not covered by the general liability or the property. The only place you find coverage there is in the pollution liability. And I see if you have some questions. Ken, do we want to tackle those, or how do you want to handle them?
Yeah, let's, Rena and Fawn, do you want to go ahead?
Yeah. 1 second. So it says, does the floater covert to builder's risk during the project, or do you get two separate policies? I guess convert maybe.
It's a good question. So remember, we talked about the two different types of property coverage that we would purchase during construction phase, either the installation floater or the builder's risk. You would never use both on one project. You would pick one or the other. And the deciding factor is, what's the majority of the work? Is the majority of the work going to be coming up out of the ground? If it is, then you use a builder's risk policy, not an installation floater. If instead the majority of the work or all of the work stays at or below grade, then you would just stick with an installation floater. By the way, installation floaters tend to be much cheaper. So the way we approach that is, if we can get away with using an installation floater, we like to do that because it is cheaper. So hopefully that answers that question. I saw a few more pop up.
Somebody's from Cooper, why does there seem to be so much diversity in the insurance coverage expectations in the construction environment? I.e. FMCSA has a minimum requirement, different dispatchers have varied coverage requirements, and the DOT oftentimes requires max coverages for similar scopes of work.
Yeah, another good question. I really can't answer why there's such a variation, other than there is absolutely a variation. Even one DOT, you know, the Illinois Department of Transportation and the Missouri Department of Transportation have very different opinions about how much insurance is enough insurance. On the public works side, oftentimes those insurance requirements are laid out or are stipulated in the statute, in the bidding statutes. So somebody at some point in the past, lawmaker or whoever was in charge of that, laid out the insurance requirements in the bidding requirements. On the private side, it's really more of just a business decision that these owners and their lenders are going to make based on prior work, prior experience, comparable size projects. So I don't think there's a good answer to explain why there's a variation, other than, you know, no one knows exactly. There really is no consensus opinion on what is the right amount of insurance, what's the right limit, what's the right coverage. It really varies by project, varies by jurisdiction, varies by type of work, varies by who the owner is, whether they're public or private. So that's one of the reasons, by the way, why when we get these contracts from you as contractors, we have to read them. We can't assume that because we saw one, paving contract from, California Department of Transportation, that the next one's going to look exactly like it. There's no guarantee that's the case. So we have to review every single one of these contracts and make sure we understand exactly what the insurance requirements are. That's what we in the business call contract review or contract risk management. Reading line for line, page for page, those contracts, that's a critical part of this whole process, to figure out what it is we got to buy and how do we remain compliant with your bidding requirements. Make sure that you don't fall out of contract compliance and you're also not exposed.
Another one is completed ops the same as warranty?
Very similar, not identical. So completed operations covers many of the same risks that a warranty policy, if you had an industrial or commercial warranty product, would, right? So it's stuff that goes wrong after you've completed the project and turn it over. Again, leaking roof, or windows that weren't flashed that might ooze water, or a foundation that wasn't sealed correctly, where you started having water coming up through the foundations or cracking the foundations. The only difference is typically is that general liability is required. It's not actually required, but general liability is driven by what we call the statute of repose. So every state in the union has a different set of laws that govern what are contractors responsible for after completion of the project. Those are the construction statutes, and the statute of repose is the period of time after completion that the contractor can still be sued for poor workmanship, right? Bad work, construction defect. Every state's different. It ranges anywhere from 6 years up to 12 years, as long as 12 years in some states. So that same statute typically doesn't mandate that contractors provide a warranty. The general liability construction defect statute is essentially like a warranty. It's a little bit different, again, in that it's a statutorily imposed requirement on you as the contractor. Warranties are something that you and the owner can negotiate, so they're optional. Statute of repose are not optional, but they cover many of the same things. Vaughn,
We have a few more questions. Do you want me to go through all of them, or do you want me to?
We can
pause?
tackle them. Let's do that while it's top of mind for everybody.
Oh, okay. So there's another one under professional services situation. There is a payout to the employee for lost wages. What about the consulting firm's point of view? There would be lost billable services to the project owner. Does WC cover the firm's unbillable service due to employees' inability to work?
Good question, and no, it doesn't. That would fall under what kind of broadly would be defined as economic damages to the design firm or the engineering firm. That's not covered by workers' comp. Workers' comp is there for one I assume we're talking about work comp. If it's professional liability, I'll answer it for professional too. But on the work comp side, workers' comp is going to indemnify or pay back an injured employee for their own individual lost wages. Has nothing to do with the company that they work for. It has nothing to do with the contractor if they're working for a contractor. It's their own individual lost wages, as well as their injuries, right? It pays their medical bills plus their lost wages. Under the professional liability coverage that a design firm and engineering firm purchases is not really something that benefits them. It's something that protects them when they get sued by somebody else, either the owner or the contractor, alleging that they made a mistake. So it does protect or provide insurance or indemnity against economic damages, but not economic damages to the design firm. It's their liability. So for example, that scenario I described with a curtain wall, right? Under that scenario, if the owner alleged that the design was wrong, right? The thermal efficiency of that glass that they used for the curtain wall was incorrectly designed by the design firm. What they can do is they can sue the design firm and say, look, you guys screwed up. You're going to have to pay me to replace that curtain wall with the correct type of glass. Under that scenario, it would protect the design firm for that money which they had to pay the owner, right? The lawsuit, the indemnity that they owed the owner. It would not protect that design firm against any future revenue loss, right? That's purely business risk for them. But it would cover them against any lawsuits or indemnity that ride from the lawsuits from their mistakes to the owner or to the general contractor.
Let's take another question if there is one, and then we'll move on.
Somebody asked, they said they have a HVAC contract with Caltrans. They have workers' comp, general liability, bonding, umbrella insurance. Is there anything else I need?
Can I ask, are you being required to bond that job from Caltrans? Or by the GC or by Caltrans?
They said yes.
Yes. So you'll need a surety bond, obviously, to meet that requirement. And then somebody, whether it's you or Caltrans, is likely going to be having to buy either an installation floater or builder's risk. So typically in the contract with Caltrans, it will say who's responsible for that builder's risk or the property coverage, right? Whatever the property coverage is. If it's you, then you'll be required to purchase and place that, and then you charge back Caltrans for it. Oftentimes, though, with public owners, we see the public owner will carry the builder's risk or the installation floater themselves. So they'll simply say, look, it's our responsibility. We'll carry it. We'll protect your interests because you may have an interest in that property. If you buy some materials and you haven't put them in yet, and they're still on, you haven't billed us for it, then you have an interest in that. But those are the main coverages. And then the last one is professional liability. So again, what will tell us whether you need additional coverage is what the contract says. So we would basically take the contract you've got with Caltrans and read it, start to finish from the insurance and indemnity provision to see what else you're required to have in place. That's something your broker should be able to help you with, by the way. If not, you can reach out. Ingrid Merriwether and the team here have a lot of experience helping contractors navigate through these contractual requirements. So if you need some help, just reach out to us. We'll help you navigate through that and figure out what you need.
Right. Let me go to the next slide, if that's okay.
Yeah, just let me finish this slide then. So the last
go
few
ahead.
items on here in red, these are things that we wouldn't typically look at as insurable in a traditional insurable sense, but these are all really important business risks that you face as contractors. There are some indirect ways that we can handle some of these risks, like political risks, the subcontractor pre-qualification and selection. That's where things like surety bonds and SDI comes into place. But the rest of this stuff are really difficult business risks that you as a contractor have to navigate. Now, as the broker, we may not be able to buy insurance to protect you against this, but many brokers, ourselves included, have a bunch of other resources available on the safety side, on the quality management side, to help provide either advice, maybe some consulting, even some hands-on guidance on how to navigate through some of these other issues. But when we approach a client as a contractor, we don't just look at the insurable risks. What can we purchase to protect them, or what can we help them purchase to protect themselves? We have to look at all of these operational risks too, because they're all part of the bigger puzzle of helping contractors figure out a way to bid this work and ultimately make some money off of it. Otherwise, what's the point? Well, next slide, please. So we can go to that next slide. All of that sort of leading up to this is, what can you do, right? These are all things that you're being required to buy. They're being basically contractually pushed down to you either by the owner or oftentimes by the GC. And most of the time it's take it or leave it, right? You really can't negotiate around very many of these points. Sometimes you can, but typically not. So you're going to have a spend, you're going to have contractual requirements, you're going to have insurance requirements. How can you manage, at least attempt to manage the cost associated with this? So everything on this slide is something that impacts typically up or down, right? Positively or negatively, but impacts your cost of insurance, ultimate cost of insurance. The first is probably the most important, which is a safe workplace. Everybody wants to aspire to a safe workplace. I think it's really top of mind for most contractors now, not just because it's you want to reduce your insurance spend, but because you got people that work for you, you want to send home in one piece. Nobody wants to get killed on a job site or to get hurt, right? This is a job. We want to be able to go home to our families. So the most important thing that contractors can do is really just think hard about safety and make sure that you're fully committed, doing everything that you can do to run a safe job site. Everything from, tool talks to good training to, gathering data about what is and isn't working in the field by way of safety so that you can improve it, right? All of this stuff really moves the needle and really changes the view of the insurance marketplace about you as a contractor. If you can prove to them that you've got all of this buttoned up, you've got a tight safety program, you honor it, right? You follow it. You impose this on your crews. Everybody's bought in. The management's bought in. That really can change the outcomes that we get from the insurance marketplace by way of pricing. Second related thing is the sort of, again, rededication to skills training and employee retention. The retention is very important right now for most of our clients. Trying to keep up with the flow of work, trying to hold on to their best employees and not lose them to poaching from other contractors or leaving the industry. All of this is also tied back to training, and the training comes back to safety, right? There's an interesting graphic that we see a lot in our industry, this bell curve. And the bell curve, what we do is we look at kind of who has accidents on job sites in construction. And if you think kind of to the left-hand side of the bell curve are people with very little experience, like newbies in the industry, and all the way to the right are folks that have been doing this for 50 years. Those two are typically I guess it's an inverted bell curve, right? Those two are the most, that's where we have the most claims. Brand new people, and believe it or not, people that have been doing this for 30 or 40 years. Brand new people, it's pretty obvious why, right? They don't know any better. They haven't been trained fully. They haven't been out and had experience in the field, and they tend to make mistakes. The other end is a little more counterintuitive, but what we see is folks that have been doing this for a long time, 20, 30, 40 years, tend not to take new training on board because their attitude is, look, I've been doing this forever. I know what I'm doing. Stay out of my face. Just let me do my work. Also, those people tend to be a little older in age, and they also tend to get, when they get hurt, they tend to get hurt more seriously. So in the middle is folks that have been doing this for a little while. They're still in good physical shape, but they're also not so far into the industry that they've basically just decided that they're experts and they don't need any help, right? These are people that are still trainable. That's the ideal part of the bell curve, right? That's just the nature of the industry. And right now, as most of you know, we're in a difficult spot with experience and with staffing, because most of the folks, we've got this aging out happening in our industry. We've got a lot of older folks my age and older who've been in the industry for 20, 30, 40 years who are retiring, and we're not replacing them fast enough with young people. So now it puts pressure on everybody to do more, do it faster, improve productivity, and still stay on your schedule, right? That's a recipe for disaster with most contractors. And we're seeing that play out in the work comp space. Third one is related also to the insurance, which is the quality control. Safety tends to show up from a claims perspective during that premises portion. Remember the first half of the general liability policy I mentioned around premises, and also work comp, right? That's where safety, when we have a safety problem, that's usually where we see the safety problem happen, is during work comp. We see claims pop. We see work comp claims accelerate. On the quality side, when we see quality problems, that happens in the second half of the general liability policy, that construction defect phase. Bad work, bad pour, somebody's, not spacing rebar right for a slab pour, basic stuff that you get trained to do a certain way, but either you're moving too quickly or you're taking shortcuts, or maybe you haven't been trained properly, fully, and you create these quality issues. Those quality issues get very expensive later on, because now let's say, again, these are examples we're dealing with right now. We have a contractor who had a new electrician who was hanging conduit, and they misread the plan and they put the wrong, too small a conduit into the wall. Then the wall got sealed up, and then when they went to pull the wire through, conduit was too narrow. They had to tear all the sheetrock off, pull all the conduit out, and put new conduit in, right? That was an experience problem, but it was also a quality problem, right? Nobody got hurt, thank goodness, but it set the schedule back. It added cost from the contractor's perspective because it had to be fixed. If they didn't fix it now and they finish this building and turn it over, that could have been a fire hazard or could have been a performance issue. That's all about quality control. That's one of the most difficult things as contractors that you have to try to manage, because that's a very difficult thing to manage. Very difficult. It's not, and there's no consensus on how best to do that. We have an opinion, and there's some technology and some other things that are out there now that can help us measure that better, and therefore begin paying attention and tracking it better. But that's a very, very difficult thing to do. Some other stuff you can do to move the needle in a positive way is, periodically shop your insurance program. Market conditions change. Insurance is a commodity like steel and concrete and lumber and everything else, right? It goes up and goes down with supply and demand. So, we don't typically advise shopping or sending your remarketing, we call it, shopping your program every year, because there usually isn't enough change from one year to the next. Plus you tend to wear out the insurance companies, and they'll stop quoting eventually if you do that too often. But usually every 3 years or so is a really good time to just, hey, look, just press the reset button. Let's go back to market. Let's talk to some new insurance companies. Let's put our program in competition and see if there's another insurance company out there that might be more competitive, because those conditions change. Every year they change a little bit. Over 2 or 3 years, they could change substantially. When you buy an insurance policy and you pay that premium, in that premium typically is embedded some services that your carrier is providing to you as part of the deal, right? Part of the premium. Many contractors don't take advantage of that. And this is particularly true around things like loss control or safety engineering. your insurance company, almost all of them, will provide some level of support or training or advice or consulting as part of the relationship with you. When you buy premium, especially if you're spending a lot of money, typically they're more than happy to send their engineers out to meet with you, to walk the job site, offer some advice, ask questions. You can ask questions. You can challenge them with, how can I do this better, right? You're paying for that in the premium. Take advantage of it. That's all about trying to help just get better at all of this, right? Get better at building, get better at estimating, get better at the whole process. As I mentioned earlier, this idea of negotiating, oftentimes, especially with public work, there's no latitude to negotiate. When you're a sub and you get handed a contract, basically it's take it or leave it. In private work, though, oftentimes there is some room to maneuver and negotiate. So what we do when we're working with one of our contractor clients and we get a contract from, let's say, a GC or an owner that we think is a little heavy-handed, right? Maybe they're asking for much higher limits than we would typically see for that scope of work, or they're asking for coverages that we wouldn't normally expect to see, or really are expensive to buy, right? Maybe available, but they're super expensive. We'll ask our contractor to get us on the phone with the GC or the owner, say, hey, look, let's talk about this, right? Why is this necessary? What problem are you trying to solve? And by the way, we read a lot of these and we typically don't see this. What's unique about this project that you're requiring these higher limits or this special coverage? Again, we may not be successful in talking them off a ledge and talking them out of it, but at least we want to have the conversation. Because oftentimes, if you don't ask, you don't get. So where we see something that's really kind of out of the ordinary, beyond reasonable and customary, we'll ask the question. We'll challenge it respectfully, and see if maybe we can convince them to back off a little bit. It's worth asking. It's worth trying for. Last two items. Getting to know your underwriters. This sounds like a sort of motivational poster, but I'll tell you. From personal experience, you buy an insurance policy from an insurance company, and really all you ever see is the policy, and then hopefully if you have a claim occasionally, hopefully not much, but if you have a claim, you'll see the adjuster, right? That's the interaction you have with the carrier. I think personally, it's really important for you, if it's possible, right, for you to get to know the insurance underwriter that's underwriting your risk. And all you really need to do is ask your broker. Most underwriters love to get out of the office and meet their contractor clients. They love it. They look forward to the opportunity to do that. The benefit to you as a contractor to engage your underwriter and try to build something like a personal relationship is that if you ever need them, right, or if there's any gray area, and this is always gray areas, it's a little harder, in my personal experience, for an underwriter to just reflexively say no or deny a claim if they have a relationship with the client. Again, I can't prove it. But I can tell you from 40 years of dealing with claims and seeing some go the right way and some go the wrong way, having a relationship with your underwriter, even if it's just, meeting them once or twice or going to lunch once a year at renewal or whatever the case may be, that personal relationship can pay dividends later in the event you ever get in a sticky situation with a claim, or more often, if let's say you had a tough year and you had some claims and the underwriter's, hey, I don't know if I want to renew you or not. Again, it's harder to just reflexively say no to you if they've got a relationship. Again, I can't prove it, but I can tell you from personal experience that's how the underwriters think. So take advantage of that too. And the last one, this is generally true, right? It sounds like stupidly simple, but it's true. There's really only two surefire ways to save money. Take more risk, buy less insurance. One or both of those things will save money. In some cases, you can't buy less insurance because the contract's going to require you to buy, it's going to stipulate we have to buy. But taking more risk is not a bad strategy if you feel that you've got your safety buttoned up and your quality buttoned up and you're betting on yourself, right? That's where taking more risk really can pay off. And ultimately, that's what most contractors, as they continue to grow, right, get bigger, drive more revenue, bidding bigger projects. The only surefire way to control your cost is put yourself in a position where you feel comfortable taking more risk. And that's all about making sure that your safety and your quality are buttoned up. You got the process in place. You've trained your people well. You've got a good, solid program in place. You understand your underwriters, where your underwriters' head is at and what they're concerned about. Taking more risk can pay off big dividends, but you got to do it carefully. You got to think about it. Ideally, you do that based on some data, and your broker can help you develop some data to figure out what the right amount of risk is to take based on your prior experience, what your risk appetite is, how big your balance sheet is. So those are all things that factor into how much risk you should take, but that's something your broker can help you with. Next slide, please. Now you've got training. I think, you know, Ken had mentioned that there's some training that Merriwether Williams team has coming up. We also have some additional training. These are all things that sort of go deeper dive on everything we just talked about today. So again, I defer to Ken. This is all content, Ken, that we've got available. If any of these topics spurs any interest with your network, we're happy to come back and talk in more detail about any of these. The one I highlighted in red is one that would probably be the most relevant for this conversation, because as I mentioned, we've talked today about insurance, right? What are your insurance requirements? How's that, you know, why do you have to buy insurance? Well, the main reason you buy insurance is to meet your contractual requirements. So we also have a whole program, a whole curriculum around contract risk management, which is reading those contracts, understanding what they mean, and understanding what that translates into from an insurance perspective. That's a much deeper dive on some of these contractual requirements and how to help you meet those with the least cost as possible. So that's some content we can offer up and follow up to, Ken. And I think that's it. One more slide. That might be our question slide. That's it. So that's all I got. Any other questions from the group?
I saw some more questions come through. Sorry,
Okay.
let me scroll down. I'm gonna work my way up from the bottom because it kept
Okay.
coming
No
through.
problem.
What is recommended for insurance if the owner may opt to sub the trades directly and bypass the GC? Performance bond or terms?
So we're seeing that more frequently, particularly when an owner is working with a small business or a women or minority-owned business, right? The WNMB environment. Many owners, for a variety of reasons, are looking to increase the amount of direct activity, direct contracting they can do with that small business community for a lot of reasons, political and just it's good business too, right? So what you should buy, again, the first answer to the question is, what does the contract require you to buy? That's the first thing we start with. What does the contract say? How much do you have to buy? And then normally what we'll do is once we establish what has to be purchased by contract, then we'll sit down with the client and say, look, here's what you got to buy. You know, what are you comfortable with, right? How much risk are you willing to take, or how much concern do you have about, you know, something like a construction defect happening on this project? So baseline is, what do you have to buy? That's the starting point. But then we work up from there and say, you know, again, it's your business. You got to protect your own interests. You got to have an opinion about this. So that's a conversation that we'll have, though. But it's all really, really project and case specific. Depends on who the owner is, where it's being built, what's being built, how big is the project, what's your scope of work, right? Is it painting, or is it, you know, fabricating structural steel for our skyrise, right? Those are two very different risks.
So the next one is, what type of insurance covers inflation?
Yeah. Believe me, if I could insure against inflation, I would be retired sitting on a beach in the Caribbean right now. There really isn't a good insurance solution to inflation. The way the owner typically protects themselves against inflation is having, you know, LDs or some sort of contract escalation provision in the contract, right? Protects them against your cost going up beyond a certain point that they can no longer afford. It's very difficult for contractors and subcontractors to protect themselves against that. So normally the best solution is to make sure that you understand what your own supply chain looks like, right? How much volatility do you have in your own personal supply chain? If you're a concrete sub, you know, you really need to understand what's the local market right now? What's the volatility in the local concrete market? You know, how far out is the project? If it's 60 days out, I have a much higher degree of confidence that my price is good than if they're asking me to bid a project that's not going to start for a year, right? So the only true way, and this is an insurance issue, but is to have some sort of escalation clause in the contract, especially if you're being asked to bid around a materials requirement that's, you know, 6 months, 9 months, a year out, right? who knows what concrete or steel is going to cost a year from now, especially in the current environment with, tariffs and things that people are threatening right now. I certainly don't know. I couldn't tell you. I wouldn't want to bet a dollar on what's going to be happening, 8 weeks from now on the current political environment. I just don't know. So the best way is to protect yourself is to have some sort of provision in the contract, if you can negotiate it in, that covers some sort of variation or escalation around the material cost.
Does the cybersecurity rider cover federal NIST CMMC requirements, including subcontractor flow downs?
I would have to. I'm not familiar with that, or maybe maybe I'm not recognizing that requirement based on that acronym. But the short answer is I don't know. But if you want to share an example of that, or if you want to share that out through the group here, and we take a look at it, I can try to help you get to the bottom of that. I don't know though, without looking at the actual term or the contractual requirement or the federal requirement.
The next question is, what are the basic information points I should know as a new C10 business owner? This is a lot of information to remember.
Yeah, I mean, the best first step you can take is because you're going to need an insurance broker or an agent in order to help you buy the insurance to meet your contractual requirements. Find an agent or broker that specializes in construction. There's a lot of agents and brokers out there that do all kinds of stuff. They do hospitals and they do strip malls and they do apartment buildings. Again, my personal opinion is generalists don't add a lot of value. And again, this is no disrespect to generalist agents, but construction's a pretty specialized industry from an insurance perspective, particularly around the contractual requirements. So best advice I can give you is find a good local broker or agent that knows and understands construction and let them help you navigate those requirements. If you can't find one, let us know and we can try to find a way to hook you up here.
Next question.
Anything else, Fawn? Was that it?
There's a really long one here. I was going to try to see if I can send it directly to you, but I can read it off. It says, we are a small construction company, and here's a brief overview of our situation. The company does not operate a fleet of vehicles. As the owner, I drive a personal truck, which is not typically used to perform construction work. Our employees also drive their own privately owned vehicles, and they are not company vehicles. Given this structure, could you please help me understand, why would commercial auto insurance still be required by agencies or certain clients, even though vehicles are not actively used to perform project work? Is it possible to request a waiver or void the requirement in cases where company-owned vehicles are not used? And lastly, would non-owned auto coverage covering employees using their personal vehicles be sufficient in our situation instead of a full commercial auto policy?
Okay, so really kind of three basic questions there. But let me start with the last question first. There's an endorsement. There's a special coverage under the auto policy called hired and non-owned auto, and it is exactly what it describes. So these would be vehicles that you, as the contractor, might be using that you don't own, right? You either rent them or you borrow them, or it could be your own vehicle. If you have that hired and non-owned auto coverage, if that's on, you can actually buy an auto policy without having any autos on it. That's not typical, but you can do that, and you can buy it with just these stripped down endorsements on it. So that's possible, and it's possible depending on how the contract's written, that could meet the compliance requirements of your owner or of your GC, whoever you're contracting with, right? Normally, if you, as the business owner, don't own any vehicles, or the business doesn't own any vehicles, then there's really no practical way for you to meet an auto insurance requirement because you don't own any vehicles. So contractually, you might be okay there. Again, it depends on how the contract's worded. But from a risk perspective, you've got some serious exposure potentially here. And you've got it from two different directions. Number one is, if you own that vehicle personally and therefore you insure it personally, right? Most personal auto policies will have either an exclusion or a limitation on their policy saying, hey, you cannot, we're insuring this for your personal use. If you use this for any sort of work-related activity, we're going to deny the claim, right? Most personal auto policies have language like that in it. So it could be something as innocent as simple as, you're driving from the job site to Home Depot to pick something up, right? And running, picking up a nail gun or whatever it is. That technically is using it for work, right? And if your personal insurance carrier learns or gets wind that that's why you're using it, and you subsequently have an accident while you're on that trip, they could deny that coverage. They could deny that claim. So you got to be really, really careful using your personal vehicles for business use, even if it's sort of incidental business use. That's part one. Part two is if you have any sort of logo, name, your company's logo, or you got a something that identifies that truck as being part of a construction company or firm, just putting that sign on that truck, you've now put a bullseye on your back from a claims perspective. So if you've got any kind of a custom truck with logos or anything like that related to your business, then you could have a real problem, even if you're not using that truck in business, right? That's a different issue. But the other problem you run into is, let's say that scenario of running back and forth to Home Depot, right? Let's say you're on your way back from Home Depot with the nail gun and you get in an accident and you hit somebody and they, somehow or another figure out that you're a contractor. Maybe you've got a bunch of stuff in the back and you look like a contractor, right? They'll sue you, right? They'll file a claim against your auto insurance policy. And if they find out that you happen to be in the course of business, right, running an errand for your business, and this is what plaintiffs' attorneys do for a living, is they dig into these things and try to find this stuff out. And they sue your business, right? Because what a good plaintiff's attorney is going to do is, if they think that you're using that vehicle for business purposes, they're going to sue you personally and they're going to sue your business, right? They'll file a claim against both. Personally, your insurance carrier might respond and defend and indemnify you, right? Assuming they don't deny the claim. But if they name the business, you've got no coverage for that business, right? Because you didn't buy insurance. So your business is completely exposed to that lawsuit. You got no coverage. So it's a really tricky thing. If your business does not own any vehicles, that's why you really want to get some good advice from your local broker, from your insurance broker. That's a good question to ask them, because again, it's very circumstance specific. But as a general rule, we don't advocate, we don't recommend using personal vehicles for business purposes in any way, shape, or form, because there's just multiple ways to get tagged doing that. You gotta be really careful with that.
Okay, and then one more. What if a project includes both public right-of-way construction underground and construction of homes above ground?
So first thing I would look at is the contract that you have with whoever the contractor, the developer, the GC, whoever, is all of that scope included into a single contract? If it is, then we would use a builder's risk form. I assume that's what we're going with, is the property stuff, because part of that work is above ground. If any of it is above ground, then we have to use the builder's risk form. And that's pretty much the general rule across the board. So remember, if it's at or above ground, any of it, then we probably have to use the builder's risk form. If it's exclusively at or below grade, then we can probably get away with an installation floater. But again, good question for your broker. And they should be able to help you navigate, which one of those options is going to likely work best for you. Sometimes, by the way, it'll also say in the contract. The contract may stipulate specifically what you have to buy. So I've seen this, I don't understand it, but we have to comply. I've seen owners require contractors to purchase builder's risk for things like, foundations and footings. Makes no sense from a coverage perspective, but it's a contract requirement. So we'll buy a builder's risk policy, which is kind of overkill, but we'll buy it because the contract requires that we buy it. Not because it makes any sense, but that's what the contract says. And that might be one of those areas where you and your broker can get on the phone with the owner and just kind of explain to them, hey, look, I understand the contract says builder's risk, but just so you know, that's really not what a builder's risk policy is designed to do. We think we can do this probably properly with an installation floater and probably save you a few bucks in the process. That's the kind of conversation around negotiation you actually can have.
Okay, and I think this is the last one. I was trying to check and make sure that I said all of them, but what are the factors that affect contractors' bonding rate, especially for small businesses? My rate has been 3%. When will my rate be less?
Good question. So unlike insurance rates, which tend to go up with when you have bad claims or you have a higher risk, right, higher hazard work, or they go down when you have good claims and lower hazard stuff, bond rates are typically fixed, right? They don't go up or down based on the risk. Usually bond rates are only going to move down, right? They're only going to get cheaper as the value of the bond goes up. So it's volume based. That's almost always the case. So again, and the reason that is because surety companies have to file their rates with the state, whatever state they're operating in. So they can't just change their rates based on, offering, I'm going to give you a better deal, so I'm going to give you a better rate. They don't have that latitude in most cases. Those rates are filed with the state. So typically the bond rate's either going to be fixed based on the contract volume. Oftentimes we'll see what we call stair-step or graduated rates, right? Where the first, like, let's say you've got a $10 million job. The first 2 million might be at $3, then the next 5 million might be at $2.50, and the balance of it might be at $2, right? That sort of graduated rate, we see that pretty frequently too. But it doesn't move up or down based on the risk. It moves up or down primarily based on the volume or the size of the bond.
One just came through. One second. No, it's what if we're installing a monument, would that be covered by or under BR or IF?
So assuming the monument is not buried in the ground, I'm assuming that would be a builder's risk claim. But again, very circumstance specific. So we'd probably need to get a little more detail on the scope of the work. But likely anything at or above the ground that's being installed, built, whatever, is typically almost always going to be covered under a builder's risk form of some sort.
Please let us know if we missed anyone. I think I went through all of them.
Yeah.
Let
And
me,
somebody had a
sorry.
drone question, it looks like.
We're getting some questions also about contact information. So let me go ahead and do a share screen again with the information I shared at the beginning. And apologies to those who who have questions. We'll keep going here for a little while
we got
longer.
Another few minutes.
Yeah.
I saw a question come through on drones, but then it disappeared. So what was that, Fawn?
I was reading it too.
Oh, okay.
I saw oh, here we go. Sorry to have joined late, but this is as early as I can make it. Was drone insurance discussed? Our company is currently in the LAUSD boot camp for construction contracting, and we want any tips for orthomosaic mapping, 3D mapping, BIM overlays, volumetric measurements, cut and fill mapping, high accuracy survey grade equipment with caveat that we cannot officially offer surveying since it has to be signed off by a licensed surveyor, but we can be contracted.
Yeah, so we did briefly address drones. So the main risk with a drone, well, there's two main risks that from an insurance perspective that happens when you fly drones. Number one is thing falls out of the sky and lands on somebody's head and kills them, or lands on their car, or lands on a building and starts a fire, or whatever, right? The physical damage of the drone falling out of the sky. Doesn't happen very often, but it can. So you have to insure against that. That's a liability risk. The second bigger risk, believe it or not, is privacy invasion. And I can't tell you how many claims I've seen over the years, especially in the early years of drones, where somebody would allege that some contractor or somebody was flying a drone at a job site next door and it overflew their house or overflew their apartment building, and they are saying this thing was filming into my apartment, or I was sunbathing on the top of my roof and it filmed me, right? Those are also liability claims under personal damages or personal injury type claims. That's something else that you can insure, and typically we have to insure with drones too, is that invasion of privacy, the privacy issues. What you just described using the drones for is exactly what we see them used for too, is overflying job sites to look, surveying damage, surveying generally, doing quantity survey offtakes, things like that, right? So normally most contractors nowadays, in the early days when drones were first used, contractors would buy them and they would train somebody on their staff to be able to fly the thing, and they would start, playing around with this and fly it. Nowadays, because of the liability associated, is many contractors now subcontract out the drone, whatever drone activity they need to do, they subcontract it out to a licensed drone operator. The benefit of doing that is that operator, again, you got to check this, but that operator should be carrying all of these insurances we just talked about. So when you contract, you sub out to them, it's like the GC subbing out to you. You're going to put certain minimum insurance requirements on them that they're going to have to meet and demonstrate to you that they've met as part of that contract. So that protects them and you. That's generally what we see most contractors do now is, again, because you have to be licensed to fly anything over, I think it's 8 pounds, or I forget what the number is now. Anything of any size at all now, you have to have a license to fly that drone, and you also have to buy insurance and evidence the insurance too. So even when you do that, there's still risk. So if you can sub it out and it doesn't bust your budget, that's probably a better option for you in most cases.
Any other questions?
Yeah, someone wants to know if you can explain the EMR experience modification rate. What would be my score as a new contractor?
So yes, so EMR stands for experience modification rate, right? EMR. What an EMR is it relates to work comp, and it relates to your experience as a contractor over some period of time. Typically an EMR, a full EMR, right? A fully matured EMR, it takes in 3 years of prior loss experience of you as a contractor. So what they'll do is if you've been in business for at least 3 years, right? Every time you have a work comp claim and every time you pay work comp premium, all that data gets reported to an organization called NCCI, which is the National Council on Compensation Insurance. It's like a national clearinghouse of work comp information. That organization will take all that data in, they do a bunch of analytics, and they report back to every state. So every state that you operate in will have a detailed history of how much premiums you paid every year and how much have you incurred, right? Has the carrier paid out in comp losses on your behalf, both medical losses and the lost time, right? The wages part of it. They track them separately. All of that stuff gets baked into a calculation or a ratio. And that ratio is basically, any 1.0 is what we call unity mod, right? That means that your, I guess, average is the best way to put it, right? Is that you're an average contractor. So when you start out as a brand new business, you start out at a 1.0, right? You have no experience, good or bad. So they start you out at a 1.0. Over time, if you have better than average experience, that mod's going to go down, right? We call that a credit mod. That becomes an important thing when you're bidding work, especially to GCs as part of your pre-qual process. Oftentimes GCs will look at your EMR, your work comp mod, and if you've got a very high mod, say 1.3, 1.4, which is, implies that you've had a lot of claims problems, sometimes that can knock you out of bidding work for them, right? Because it implies that you're not safe, you're not running a safe job site, your work comp's elevated. The alternative is you run a really low mod, right? A 0.6, 0.7, which is pretty low. That implies that you're running very, very safe, and that can really help you in bidding, right? It can actually give you an advantage in a bidding situation. So, but to answer your long answer to a short question, as a new contractor, you start out as a 1.0 until you get a couple of years experience, and then you'll start going up or down based on your experience. And that's calculated every year. So every year it'll update. And by the way, if you ever have any questions about that, your broker can actually run what we call a test mod. So if you've been in business for a couple of years, they can actually take your information. So this isn't necessarily something they get from the state. There's a piece of software that we all have access to that they can take your current losses, your current premiums, and they can basically forecast what your mod should be. So if you don't want to wait until the new mod comes out every year, you ask your broker to run what's called a test mod, and they can actually tell you kind of ahead of time what that mod's going to be, so you can prepare for it when you're bidding.
I just want to interject here for a sec. Yeah, the recording will be shared. You will be given a survey link. We will also provide you with a copy of the presentation. We can go another few minutes here because I think there's a couple more questions.
Sure.
And I want to put up the survey link for you.
Okay, so there's another one that kind of goes with what you were just talking about, the EMR. So workers' comp, a construction worker reported a piece of wood falling on him to his superintendent. The superintendent asked if he's okay and is good to continue working. And the worker said he felt fine. The worker's scope finished a few days later and had to be terminated. But now the worker wants to seek a WC claim. The contractor emailed the worker 2 weeks after the incident to see if he needed medical attention at that point and received no response. Does the worker have a valid WC claim? What advice would you give to contractors when dealing with any on-site incidents like this?
Yeah, great question. Short answer is very likely that worker has a valid claim. It may seem like, pardon the French, bullshit, but they probably have a valid claim. So the best you can do as a contractor is document. When that worker first reported to his supervisor that a piece of wood fell on him, what that supervisor needs to do is file an incident report, right? Contractors, all contractors typically will have some sort of a paper form, or maybe they do it electronically. A lot of our clients now do this electronically with an app. But take 30 seconds at that point, right when it happens, document time of day, what happened, who did it happen to, where were they at, all the details that form requires. Ingest all of that information into that form and document. That's the best you can do, because then at some point in the future, a week later, if they get laid off or it's the end of the season, right, and you start laying crews off, that's when we see a surge in work comp claims, because keep in mind these guys were no longer working, right? This is another source of income oftentimes for folks, unfortunately. So you can't defend yourself. You can't argue that it's an invalid claim in most states. The laws are very favorable to the worker in almost all states. California is particularly favorable, so is a few states. So the best you can do is document. And your broker can, if you don't have them, your broker can help you either find or develop a real simple form that allows you to document all of this activity when it happens. You got to do it contemporaneously, right? You got to do it when it happens in order for it to be helpful for you at some point in the future. Just document. That's the best you can do. And by the way, if this is a little more beyond the scope of the question, but what most contractors ultimately will do, because the most expensive kind of work comp claim is one in which the employee loses time, right? What we call a lost time claim. The medical is also can be expensive, but the biggest claims tend to be ones where an employee alleges that they got hurt and they're off work for 6 weeks or 6 months or years, right? It can go on forever potentially. So one of the other things that you as a contractor can do to kind of minimize that is to have a back to work program. Many of you probably do. If you don't, you might want to, again, have your broker explain to you what a back to work program is, how it works, how to set one up, and what the benefit it is for work comp. Because the sooner you can get your injured employee, if they're alleging that they got hurt on the job and they can't work for some period of time, a few days or a week or two, the sooner you can get them back to work in any capacity, even if it's just sitting in the office filing files or doing art projects, doesn't really matter. As long as they're on the payroll and back to work, then they're off your work comp, right? They're no longer filing a work comp claim. So it's no longer going against your EMR and your experience. So get them back to work as soon as you possibly can, even if it's BS work. Anything's better than nothing.
Any other questions?
Yeah, there's another one. For the workers' comp insurance audit, I was told timesheets are required, but is it true that it needs to show clock in and clock out times? What will be the best way to provide proof of the timesheet, especially for construction workers not so tech savvy? Also, why workers' comp insurance for glazing is higher than any other trade?
So let me start with the last part of that question. So work comp rates are based on the market, the insurance company's view of the degree of risk associated with the work, right? So at one end of the extreme, I've got somebody, I've got my office manager sitting in a trailer or in the office doing filing, answering the phone as my receptionist, right? That's a relatively low risk activity. Still work comp, right? You still have to pay premium on that person and their payroll, but it's very low risk. The other extreme is what you just described. You got a curtain wall contractor who's might be hanging off the side of a 20-story building, bolting on curtain wall. That's pretty risky stuff. So the rate for that work comp is going to reflect that risk, right? So the higher the risk, the higher the rate. And by the way, glazing contractors are not the most expensive. They're far up there, but there are other things, demolition, there's some demolition trades that are very high risk. We do a lot of deep tunneling. We've got some very, very high risk deep tunneling trades, folks that are 250 feet underground, blasting. That's pretty high risk too. So it's a reflection of the risk. of the type of work that they're doing. And on the audit, this is a question we get all the time. So every carrier will have a slightly different process for doing audits for work comp. And they do this for GL too, because remember, there's a lot of these policies are auditable, right? You go in with an estimated premium, and at the end of the policy term, the carrier has the right to kind of true that up based on, projected sales versus final sales, or projected payroll versus final payroll. And that's good for everybody because you don't want to over or underpay. You want to pay the right amount. So every carrier will have a different process. And it varies. So if you've been with the same carrier for 3 or 4 or 5 years and you kind of understand what that audit process looks like, and next year you're moving to another carrier, what we always do is almost always do is we request a test audit. We do a test audit from the carrier with the carrier. So halfway through the policy term, we say, hey, look, Mr. Insurance Company, we'd like you to come in and just mock audit us, right? Just come in and show us what that process is going to look like, so that when we do the real audit at the end of the year, we don't get caught off guard. We know what paperwork you're going to need. We understand how much documentation you're going to expect from us in order to make the audit correct. And we know, what the turnaround time is going to be. So usually, again, some carriers are very lax about audits. Sometimes they'll send you a form. Many times they'll send you a form and you'll just fill out the form and mail it back. And that's the audit, right? It's kind of the honor system. In other cases, if it's a larger client, if there's some discussion or debate about how you've classified employees, right? How many people that you're claiming are in the office versus out in the field doing actual hazardous work. Sometimes the carrier will come out and want to look at timesheets. So they'll want to look at job descriptions. They'll want to look at schedules. They have the right to do all of that under the terms of the contract, the work comp contract, the audit provisions. So best thing to do is ask the question. Again, this is where your broker can help you, is make sure that your broker understands, and therefore you understand what the insurance company's process is going to be for audits. What's the information I'm going to be required to provide? What level of detail does that information have to include? And when and how do I have to get that information to you? Because every carrier is a little different.
Let's take one last question before I wrap things up here.
Okay.
Okay, so let's see. My company provides programming services. We have general auto and E&O insurance, as we are contracted by a large customer. Once we start getting more projects with other companies that only hire us for a short period of time, what is the best way to deal with our insurance?
So all insurance, and this is again a general statement, this is pretty generally correct. All insurance typically is rated and priced, and therefore you pay on an annual basis, right? Every year you get a policy, just like your auto insurance or your homeowners, that renews typically once a year. So at the beginning of the year, when you buy an insurance policy, your broker is going to ask you to estimate, what do I expect in the next 12 months to do by way of revenue and payrolls, right? Those are the two main things that drive the liability side, and professional liability too. Again, it's an estimate because you don't know either, right? You could wind up having a great year and doing twice as much. You could have a terrible year and do half as much. So we estimate going in. At the end of the year, in most cases, the carrier then reserves the right, and they typically exercise this right, to come in and audit, right? We just talked about that audit. They're going to look at your books, your payroll, your revenue, what did you say you were going to do? What did you actually do? And then we're going to true all that up. If you're a growing business, and I'll say this out loud, please don't quote me, but what we typically do is, if you're a young company, right, new company, and you're growing and you're not quite sure how quickly you're going to grow the first couple of years, is we generally recommend, again, I'll say this out loud, that kind of underestimate a little bit what your payroll and revenue is. And the reason I say that is, again, the carriers reserve the right to come in at the end of the year and true it up, right? So if you underestimate by 25% and you wind up killing it and have a 200% upside year, they're going to collect that money anyway. But if you have a terrible year and you estimate you're going to do 5 million, you only do 3 million, sometimes it's hard to get that money back from the carrier, right? Once you've paid that, to get it back is not as easy as them coming back and asking you for money. So I don't want to say we lowball, because that's not what we're doing. But what we do is we go in with a conservative estimate of what payrolls and revenues are, because again, those are the two things that drive your premium on the liability side. The best guess you can give. Because again, let's say, again, everything's measured over an annual period. But if you have maybe, 2-week projects or 3-week projects or 6-week projects, we're not pricing it based on 2 or 3 or 6 weeks. We're pricing it on average over the course of that entire 12-month period. Hopefully, I'm not sure if that answered the question. Hopefully it did, but if not, let me know and course correct me if I answered the question the wrong way.
They wanted to know if or they wanted to know how they get their score.
Their score for
Let's see. I think they're talking about the EMR. It's a separate question.
Oh, sorry. Okay.
But
So-
same person.
Yeah. So, but same thing, right? Is work comp is just like the other policies. It's written on an annual basis, 12-month cycle. So we don't look at the carriers and the NCCI. Remember, that's the people that calculate these scores. They don't look at a single project or a single 6-week, job or a 12-week job. They look over the course of 12 months, however much work you did, however many projects that comprised over 12 months. We add it all up into a single 12-month period. And we assess the estimate or the calculation we do is on that 12-month period, both premium and claims, right? Amount you paid in, amount the carrier paid you and paid back in claims. That's how that calculation is produced. It's not on a project by project basis. The only exception to that is if you're in wrap-ups, and some of you may be participating in wrap-ups, right? OCIPs or CCIPs. In that case, the calculation is still the EMR, if you will, is still calculated on an annual basis because that's the way the formula works. But the claims are tracked over the life of the project, not on an annual basis. The calculation is still performed annually, but the total claims are calculated over the life of the project, however long that project lasts.
All right, let me wrap things up here, and apologies for the disabled chat in the beginning there, and that's why we went over by a bit. But first of all, let me thank Kirk Chamberlain for
Pleasure.
being here today and providing his insurance expertise. And I'm sure you'll agree with me when I say that despite the cost of insurance, the cost of not having it is usually much higher.
Yeah.
So thank you.